All right, let's dive right into this explainer and look past the software illusion to uncover the physical reality and, frankly, the massive structural alpha of the AI revolution. When we hear artificial intelligence, it's incredibly easy to just picture lines of code, seamless chatbots, and these magical algorithms floating around in a digital cloud. But we really need to contrast that magical cloud with the dirty, totally unsexy reality of pouring concrete and laying copper. Because the reality of AI is shockingly heavy. It is built on steel and massive, mind-boggling amounts of energy. So today we're going to explore why the real opportunity in the market right now isn't just in the algorithms, but in the literal foundation that keeps those algorithms running. While everyone else is staring at the shiny new chips, we're going to be looking squarely at the HVAC systems.
We're going to start by pulling you underwater, so to speak, to see the massive physical foundation keeping the whole AI iceberg afloat. For years, the investment world has heavily confused tech with software. But as AI scales from experimental models to industrial-level deployment, the primary bottlenecks? Well, they're no longer found in neural network complexity. They are found in the rigid, unforgiving constraints of power distribution and thermal management. I mean, think about it. You can write the most elegant code in the world, but if the server melts into a puddle of silicon, your AI is dead. We've officially moved from a software-defined era into one governed by the absolute laws of thermodynamics and electric grid capacity.
Notice the profound cognitive dissonance playing out in the market right now. Investors are completely transfixed by the visible tip of the iceberg, bidding chipmakers like Intel up to record highs. But on the flip side, consider the mechanical, electrical, and plumbing firms. These are the specialty trade contractors actually building the clean rooms and the cooling systems required to make those chips functional in the first place. Yet they are trading at a massive discount, often near 40% relative to their long-term growth potential. Everyone is frantically buying the gold, but hardly anyone is pricing in the picks and shovels.
And hey, this isn't just some abstract market theory. The White House's 2026 AI Action Plan explicitly targets this exact physical layer. Their directive outlines a literal build, baby, build ethos. They're implementing aggressive regulatory relief and permitting reforms to facilitate what they're calling qualifying projects. Now, why the sudden urgency? Because by 2027, data centers will demand a staggering 92 gigawatt growth in energy supply. To put 92 gigawatts into perspective, that is roughly equivalent to the peak power demand of the entire state of Texas. To meet this, the administration is treating specialty trade skills, electricians, advanced HVAC technicians, data center operators, as an absolute national security priority. Section 1. The thermal breaking point. The end of air cooling. Okay, let's look at exactly why this infrastructure is suddenly so critical. For 30 years, we basically just relied on high-powered fans to whisk away heat from servers. But we are seeing an absolutely massive jump in power requirements. We went from the NVIDIA Hopper generation at 700 watts per GPU, which demanded 40 kilowatts per rack, to the Rubin R100 at 2300 watts, pushing rack density to 200 kilowatts. And the Rubin Ultra? That's projecting up to 600 kilowatts per rack. Just imagine running 2 industrial space heaters inside a space the size of a pizza box. That is the kind of intense thermal density we are talking about here. Air is a terrible conductor of heat, and at these incredible levels, traditional cold aisles and fans have fundamentally failed. To solve this unprecedented heat problem, the industry is standardizing on direct-to-chip or DTC cooling. This isn't optional anymore. It's a mandatory pivot. We're talking about placing high-conductivity copper blocks directly on top of the GPU and memory stacks, utilizing 45 degrees Celsius warm water inlet temperatures. Why 45 degrees Celsius? Well, that might sound pretty warm to us, but while it's warm compared to traditional chillers, it is refreshingly cool compared to the operating temperature of a melting GPU. By shifting to these liquid systems, data centers can actually eliminate energy-hungry mechanical chillers entirely, dissipating heat through dry coolers and reducing cooling-related energy consumption by up to a whopping 90%.
Section 2. The power shift, moving to 800-volt DC.
So the crucial point here is that cooling is really only half the battle. To feed these power-hungry liquid-cooled racks, we also have to fundamentally rewire how we distribute power across the entire facility. By shifting from legacy 54-volt alternating current to an 800-volt direct current architecture, operators are making a massive leap in efficiency. See, traditional data centers suffer huge efficiency penalties from multiple AC to DC conversion stages. Every single time you convert AC to DC, you lose energy as heat, which then forces you to spend even more energy cooling the room. It's a vicious cycle. The new 800-volt DC architecture fixes this by removing these conversion stages directly from the IT rack and moving them to dedicated power racks. This simplifies the delivery and dramatically cuts down on wasted energy.
Let's ground this in a bit of physics. Don't worry, just a little bit. According to Joule's first law, power loss in a conductor is proportional to the square of the current. Therefore, by aggressively increasing the voltage to 800 volts, we require significantly less current to deliver the exact same amount of power. Less current means we can use thinner copper bus bars, we have much less cable bulk, and most importantly, we generate far less heat within the power distribution network itself. It's a total game changer.
Section 3. The Picks and Shovels. Specialty Construction Alpha.
Let's move to the ultimate gold rush analogy. As we said, we aren't looking at the gold, and we aren't looking at the miners. We are looking at the literal picks, shovels, copper bus bars, and cooling pipes of the AI revolution. The reality is that less than 10 firms globally possess the full spectrum capability to manage a hyperscale data center project from groundbreaking all the way to live operations. Because this expertise is so incredibly rare, the backlog numbers we're seeing are just staggering. Quanta Services sitting at $48.5 billion, Turner Construction at $44.3 billion, and Tutor Perini nearing $20 billion. And remember, these aren't just software projections or user growth metrics. These are signed, guaranteed infrastructure contracts that provide an impenetrable financial moat.
In the physical world of 2026, the backlog-to-revenue ratio has essentially become the new PE ratio. It is the metric that truly matters right now. Why? Because in a world where software multiples wildly expand and contract based on market vibes and interest rates, an engineering and construction firm boasting a backlog-to-revenue ratio exceeding 2.0x means they have 2 years of guaranteed, locked-in cash flow. It proves they've secured massive, high-margin, mission-critical infrastructure projects stretching years into the future.
Comfort Systems USA, ticker symbol FIX, perfectly demonstrates this alpha in action. In a single quarter, they reported a 56.5% revenue surge and a massive 121% increase in earnings per share. But honestly, the really fascinating part is how they're doing it. They ramped up their capital expenditure by an unbelievable 560% in just one quarter, pushing it to $147 million to build modular fabrication facilities. They are essentially building giant, complex Lego blocks of cooling infrastructure off-site and just dropping them right into the data centers. This drastically speeds up installation for hyperscalers who are absolutely desperate to get their facilities online.
Furthermore, the physical side of AI extends way beyond data centers right into the semiconductor manufacturing plants themselves. Supported by massive government incentives like the CHIPS Act, we are seeing a global wave of reshoring. But building a fab is an exercise in extreme engineering. Critical components, like high-purity piping, currently have 18 to 24-month lead times. This piping carries volatile, ultra-clean chemicals required to print microchips without a single microscopic speck of contamination. This brutal supply chain reality heavily favors established engineering leaders like Excite, Bechtel, and Fluor, effectively securing massive moats around their businesses.
Section 4. Securing Power-Ready Land. The Industrial REIT's Moat.
But, all of this advanced hardware, cooling, and power distribution is completely useless without a physical place to plug it in. This brings us to the reoccurring revenue layer of the AI capital expenditure cycle, industrial REITs. Investors are heavily weighing these industrial real estate investment trusts, comparing two distinct business models to see who truly controls the power-ready land. And that phrase is key, power-ready. It's not just about square footage anymore. It's about owning a plot of dirt that legally and physically has access to massive grid power. On one hand, you have Digital Realty, focusing on massive wholesale hyperscale leases. They actually recently signed a historic 200-megawatt AI inference lease. On the other hand, you have Equinix relying on an interconnection density model, boasting over 500,000 interconnections to leverage the network effect of having thousands of IT service providers in a single building.
And let me explain exactly why these established REITs are trading at such an absolute premium right now. The magic words are dark fiber and energized shells. Take the timeline for the PJM Power Grid Interconnection Queue, for example. PJM is the largest regional power grid operator in the U.S. Back in 2008, you'd wait under 2 years to get your facility connected to their grid. Fast forward to 2025, and that wait has stretched to over 8 years. If you want to build an AI data center today, waiting 8 years for power is a death sentence. Tech moves in weeks, but the physical grid moves in decades. An 8-year wait is literally longer than the entire lifespan of a typical tech startup. That's exactly why controlling already energized land is so incredibly valuable today.
Section 5. The Brutal Truth.
The 2026 bottlenecks.
Okay, here is the brutal truth that completely shatters the boundless growth illusion we often hear about in tech circles. The ultimate bottleneck for AI isn't the software, and it isn't even the capital. It's human and material resources. The global build-out relies on a dangerously small number of specialist contractor firms. Hyperscalers are all competing for the exact same 3 or 4 mechanical and electrical specialists. Even more concerning is the engineering shortage. Over half of data center operators are currently struggling to retain staff, and with a massive portion of the current workforce nearing retirement age, the industry is facing a global demand gap of 300,000 engineers. Think about the irony of that for a second. The most advanced, futuristic technology in the world is currently gated by the retirement schedules of master electricians and HVAC tradesmen. This talent gap is the absolute ceiling on AI infrastructure expansion.
And this brings us to the climax of our explainer. Think about the glaring valuation gap we are seeing today. The market is valuing the dreamers at 43 times earnings, giving software-labeled chip makers like NVIDIA massive premiums. But the builders, the ones laying the actual physical foundation, firms like MCore that make those chips physically operable, remain heavily mispriced at just 20 to 30 times earnings. The market is aggressively pricing in the digital dream, but it is largely ignoring the companies fundamentally required to build the physical reality.
So, as we close this explainer, I really want you to take a moment and ask yourself a highly critical question. When the digital dream inevitably hits the physical wall of power, grids, and thermodynamics, are your investments positioned with the code or with the concrete, copper, and cooling? The true AI titans of 2026 might not be wearing hoodies in Silicon Valley, they might just be the contractors in hard hats. Thanks for joining me on this deep dive into the physical side of AI. Keep questioning, keep learning, and I'll see you in the next one.